Capital budgeting. In this section, we will talk about the importance of capital budgeting. Section 2 deals with the capital budgeting process. In Section 3, we cover the basic principles of capital budgeting, and Section 4 deals with investment decision criteria. Section 4 represents the bulk of this reading. Capital budgeting is the process that companies use for decision making on long-term projects. You can think of this as follows. Companies need to do several projects and they need to decide which projects to do, which projects not to do, what order to do the projects in, and so on. The process that companies use to make decisions about what projects to do and what not to do is called the capital budgeting process. Capital budgeting helps decide the future of many companies. The reason is straightforward. The projects that a company does helps define the future of that company. Generally speaking, capital budgeting is used for decisions related to long-term projects, long-term investments, and so on. But as you will see, the concepts that we learn when we talk about capital budgeting can be applied to decisions at a lower level. For example, how much inventory to purchase, whether or not to lease equipment, and so on. The valuation principles used in capital budgeting are also used in security valuation. These valuation principles deal with projecting cash flows and then discounting those cash flows to determine whether a project adds value or not. And the principles that we discuss here will be used later in the course when we talk about equity valuation and fixed income valuation. Corporate budgeting decisions are consistent with management goal of maximizing shareholder value. As you will see in other parts of the course, the main goal of management should be to maximize shareholder value, and the decisions that we arrive at using the capital budgeting process are consistent with this objective. The capital budgeting process is as follows. First step is to generate ideas. We need to know what are the possible projects that the company should engage in. Once we have a list of possible projects, we then need to define and decide which particular projects to execute and in what order. To do so, we have to analyze each of these individual projects. Simplistically, you can think of the output of step 2 as the list of profitable projects. Step 3 is planning and capital budgeting. Here we look at the list of profitable projects and identify which projects are aligned with the strategy of the company. We also need to look at the fact that some projects might seem profitable in isolation, but when we look at them along with other projects, then they might not seem as beneficial. Through the planning and capital budgeting process, we consider larger issues related to the company and identify which particular projects to do and in what order. Finally, monitoring and post-audit. Once we start doing a project, we need to keep monitoring the project to ensure that the objectives that we had identified initially are being met. When the project is complete, we should do a post-audit again to verify that the assumptions made did actually hold and the objectives were met. If not, then we define the learnings that can be applied in future projects. Project categories. Here is a simplistic categorization of the different kinds of projects that companies can engage in. Replacement projects, as the term implies, deals with projects where we are replacing equipment or machinery. You might have an old piece of equipment which is working fine, but the maintenance cost is high. you want to consider replacing this with a new machine where the maintenance cost is low, but obviously there is a cost associated with the machine. The decision that needs to be made is the following. Does the cost of the new machine justify the savings in maintenance cost? And as you will see later, capital budgeting techniques can help us make that decision. Expansion projects, this is where companies are making a given product and they need to decide whether to expand the factory or build new factories where the same product will be produced. New products and services, here a company is deciding whether or not to diversify or whether or not to offer other related products and services. Mandatory projects, these would be projects that are required by the government or by the regulatory authority. Generally speaking, the level of analysis for regulatory projects is going to be relatively low. If there are multiple ways to meet a given regulatory requirement, then companies might go through a capital budgeting process to determine which particular method can be executed at the lowest cost. Basic principles of capital budgeting. Decisions are based on cash flows. This is an important statement. Earlier we talked about financial reporting and analysis, where we come up with the net income of a company. We could also come up with the net income or accounting income of a project. So the question is whether we should use accounting income or cash flows to make capital budgeting decisions, and the answer is we have to use cash flows. This is because accounting income or net income is based on assumptions and it is based on the accrual system, whereas when we are making decisions, we are concerned with the actual cash that a project generates. Therefore, decisions are based on cash flows. Timing of cash flows is crucial. This connects with the concept of time value of money. If you are doing a project and you invest, say, 100, in project 1 you get back 200 at the end of year 10. In project 2 you get back 200 at the end of year 1. The amount of cash flow is the same, but clearly receiving that money sooner makes this project more profitable. Another related issue is that for many projects we will have cash flows during the year. What we generally assume in the capital budgeting process is that all these intermediate cash flows are bundled up and projected at the end of the period. This makes our analysis somewhat conservative because we know that if we take all these cash flows and put them at the end of the year and then calculate a NPV, that NPV will be somewhat lower than the NPV if we assume the cash flows are occurring during the year. And if we make a decision based on a positive NPV with all the cash flows shown at the end of the year, then in reality, with cash flows happening earlier, the project is actually going to be more profitable. If you didn't fully understand that point, it's not a very big deal. Generally, in your exam questions, you will be given cash flows at the end of every year or end of every period. Cash flows are based on opportunity costs. This is extremely important. Opportunity cost is the cost of the next best alternative. And I'll give you a simple example here to illustrate why this principle holds. Let's say that you are running a retail outlet and the shop that you are managing has been gifted to you by a relative. The rent for that shop, let's say, is 50. This is the monthly rental, but that 50 is not what you have to pay. It's an implicit cost because this shop was gifted to you. As part of your business, let's say you are selling laptops and the net cash flow every month is 40. Would you be happy that you are making a net cash flow of 40 every month and continue running this shop? Or would you say that you can simply rent out the shop for 50 and be better off? The answer clearly is that it does not make sense to run this operation, because by renting the shop out rather than selling laptops, you are better off. Even though this 50 is not explicitly a cost, but it needs to be considered in your decision making process. Effectively, what you are saying is that we consider 50 as a cost. The 40 is the net cash flow from your business activity. When you combine the two, you have a net cash flow of minus 10, which clearly implies that it does not make sense to do this project. Cash flows are analyzed on an after-tax basis. This is fairly obvious. You generate a certain amount of cash flow before tax, and then you pay a certain amount of tax. What you are left with is 70 in this particular example. You need to do your analysis based on the after-tax number, not the before-tax number. Financing costs are ignored. This is an important point. I will explain it briefly here, and this will make more sense as we finish this reading and the next reading on cost of capital. But simplistically, capital budgeting decisions are made based on cash flows, and then those cash flows are discounted based on a interest rate. The financing costs are built into this rate, and therefore it does not make sense to subtract financing costs from the cash flow. If we did subtract financing costs from the cash flow, then we would be double counting, because then we would be subtracting financing costs from here as well as building into the denominator or the interest rate. So just remember the fact that financing costs are ignored when we come up with the cash flows. A few key concepts. Sunk costs are not included in investment decisions or investment appraisal. The way you can think of this is as follows. Let's say that at time 0 you invest 100 into a project, and then at time 1 the project is not doing well, and you need to make a decision of whether or not to invest another 100. This is the decision you need to make. And you know that if you invest 100 over here, then the present value of the future cash flows that will be generated is 150. The question now is as follows. Should you invest this 100 or not? What you are looking at is the fact that you've already spent 100 before. You will be spending another 100, so your total cost is going to be 200, and the present value of future cash flows is 150. So should you compare the 150 with 100 and say go for it, or should you compare the 150 with a cost of 200 and say no go? The answer is that you have to compare with this minus 100 and say go for the project, because the 100 that you spent at time 0 is a sunk cost. This money will not be recovered. If you do not make a go decision over here, then effectively you lose the entire 100. If you go for the project, then notice that between minus 100 and 150 you are making 50. You have already lost 100 before, so your overall loss is 50. A loss of 50 is better than a loss of 100. Notice that what we have effectively done is ignored the minus 100. If instead of minus 100 we had minus 10,000, we would still go for the project based on the amount that needs to be invested here and the money that will be made in the future. Bottom line is, any sunk costs that have been incurred in the past need to be ignored. Your decisions need to be made based on the costs that you will incur now and the benefits that you will realize in the future. Incremental cash flows. This is also very important. When you do capital budgeting decisions, you need to consider incremental cash flows. Going back to the replacement project that I talked about earlier, let's say you have an old machine and the maintenance cost related to the old machine is 100. If you bring in a new machine, then the maintenance cost comes down to 75. In other words, you save $25. And let's say that this will happen every period, and we have 10 periods. The cost of the new machine is equal to 200. When you evaluate this project, what do? You consider the cost of 200, that's incremental cost should you decide to invest in the new machine. And the benefit every period is the difference between these two numbers, and that is 25. Minus 75 is 25 better than minus 100. So notice that we are doing an incremental analysis, or we are looking at the differences. In other words, the decision of whether or not to do the project is based on the investment of 200 and the benefit of 25 every year for 10 years. To complete this problem, we also need to make an assumption about a discount rate, and we will do that later in this reading. Finally, externalities. Externalities can be both positive or negative, and I will give you an example of each. Let's say that you are running a soft drink company and you decide to introduce another line of business where you are selling chips. This is the project that you are evaluating, whether or not to start the chips business. What you realize after your analysis is that the chips business will have a cash flow every period of 100. And because of the chips business, there will be a positive impact on your soft drinks business. The soft drinks business will give you plus 20 every period because of the chips business. The question now is whether this plus 20 should be considered when you make a decision related to whether or not to go for this investment. The answer clearly is yes. The plus 20 is a positive externality. You are getting that positive externality because of this project, and therefore you should go for it. What about a negative externality? Again, say you are a soft drinks company and you only have a regular version of your beverage. You are considering whether or not to introduce a diet version. If you introduce the diet version, that will have a certain cash flow, but because of this new project, there will be a negative impact on your original business. Let's say that negative impact is 20. This is a negative externality. It is also called cannibalizing your sales. When you make a capital budgeting decision, you need to consider this minus 20. A few more key concepts. Conventional versus non-conventional cash flows. Here you are learning the terminology, and later we are going to use these terms. In a conventional cash flow, there is an initial investment depicted by a negative sign, and then after that money flows in. The simple way of defining a conventional cash flow is that there is only one change in sign. With non-conventional cash flows, we have more than one sign change. So if we have an investment and then money flows in for a few years, and then we have another investment, this would be an example of a non-conventional cash flow. So again, simplistically, non-conventional cash flows are where we have more than one sign change. Independent versus mutually exclusive projects. We say that two projects A and B are independent if the decision to do project A has nothing to do with the decision to do project B. You might accept project A and then independently you make a decision of whether or not to accept project B. Mutually exclusive means that you only do one project. If projects C and D are mutually exclusive, then we say that okay, either we'll do project C or we will do project D. An example of mutually exclusive projects would be whether to install a conveyor belt in your factory or whether to buy a fleet of forklift trucks. It would generally not make sense to do both. So the two projects that I just mentioned would be considered mutually exclusive projects. Project sequencing. Many projects are sequenced through time. So you might do project A, and then based on the results of project A and the economic conditions, you would then do project B later, and so on. Unlimited funds versus capital rationing. Unlimited funds would mean that a company has all the funds it wants to engage in any positive NPV projects. Capital rationing, which is the more practical scenario, is that a company has a certain amount of budget or capital and it needs to allocate that limited capital to certain projects. Coming now to section 4, investment decision criteria, and this is the largest section in this reading. Analysts use several important criteria to evaluate capital investments. Some known metrics or some known methods are given right here: NPV, IRR, payback and discounted payback, profitability index, and AAR. We will talk about each of these. Let's start with NPV. We have seen this in quantitative methods, but we will cover it again over here. Net present value is the present value of the future after-tax cash flows minus the initial investment today. To come up with an NPV, we need a discount rate or interest rate. Let's say in our example that is 10%. We are considering a project where we invest 100 today, and after 1 year we will make 10. After 2 years we make 10 again, and after 3 years we make 110. What is the NPV of this project? If you look at the definition, the net present value is the present value of the future after-tax cash flows minus the investment outlay. What is the present value of all these numbers? The present value of the cash flow at period 1 is 10 divided by 1.1 because we have a discount rate of 10%. The present value of the second cash flow is 10 over 1.1 squared because this cash flow is happening at the end of 2 years. The present value of the cash flow which happens after 3 years is 110 divided by 1.1 cube. The sum of these three represents the present value of the future after-tax cash flows. From this, we subtract the initial outlay of 100, and when you put all these four numbers together, you have the NPV. If you do the calculation, what you will actually get is 0. This particular project has a NPV of 0, which means that the present value of the future cash flows is equal to the initial cost. If we had higher cash flows, then the NPV would be positive. If we had lower cash flows, then the NPV would be negative. This brings us to what's called the NPV decision rule. For independent projects, a positive NPV means that you should accept the project. Positive NPV means that if you consider all the future cash flows, their present value is greater than the cost or the initial outlay, and therefore it makes sense to accept the project. A negative NPV means that the present value of the future cash flows is less than your initial outlay, and there you clearly reject a project. What do you do for mutually exclusive projects? There clearly you accept the project with the higher NPV as long as the NPV is positive. Let us consider this example. You are given a cost of capital of 10%. Here is what you need to do. The initial cost is 1000. So you say minus 1000 plus 500 divided by 1.1, because 10% is the discount rate. So you do 1 plus 10%, which is 0.1, plus 400 divided by 1.1 squared, plus 300 divided by 1.1 cubed, plus 100 divided by 1.1 to the power of 4. You do the calculation and you will come up with the NPV, and you can use the same process for project B. As you can see, this is a very long-winded process, and if you start doing this on the exam, chances are that you will not finish on time. What you should do instead is learn how to use the calculator, and we've seen this in quantitative methods also. Therefore, you can consider this a review. Here are the keystrokes that you need to enter. You hit the cash flow button, which is right here. Second, clear work, to make sure all the cash flow registers are cleared, and here is what you should then see. You enter 1000 plus minus. That is a way of saying that the first cash flow is minus 1000. Down arrow 500, enter. This sets the first cash flow to 500. Frequency 1, because the 500 is only happening once. You enter all the other cash flows, and then once all the cash flows have been entered, you hit the NPV button. The calculator will ask you for the interest rate. You plug in 10 and hit enter, and down arrow compute. You should get the NPV of 78.82. Make sure that you are very comfortable doing this. Practice coming up with the NPV for project B, and the answer is given on the previous slide. Next, internal rate of return, or IRR. IRR measures the return for a given project. Let me go back to a simple example that I discussed earlier. Let's say you invest 100 and then you get 10 at the end of year 1, 10 at the end of year 2, and 110 at the end of year 3. What is the IRR for this project? Notice that you are getting a 10% return. With 100 investment, you get 10, 10, and then 10 plus your 100 back. So clearly the return is 10%, which means that IRR is equal to 10%. What I have done here is illustrated the fundamental idea behind IRR, which is the fact that it is giving you a measure of return. The second bullet point gives you a slightly more complicated definition of IRR, which you also need to understand. IRR is the discount rate that makes the present value of the future cash flows equal to the investment outlay. Let us see how this statement works in the context of our example. What is the initial outlay? The initial outlay is 100. What is the present value of the future cash flows? That is equal to 10 divided by 1 plus R. The R is what we will be calculating. Plus 10 over 1 plus R squared, plus 110 over 1 plus R cubed. The value of R, which makes the present value of the future cash flows equal to the initial investment, is the IRR. Notice that if you plug in 10% or 0.1 for R, you will actually get 100. So by plugging in, you recognize that the IRR is 0.1 or 10%. Clearly, this is very hard to do, and we are going to learn how to use the calculator, but the point of going through this exercise is to illustrate the fact that this statement does indeed hold true. Another way of expressing this statement is to say that IRR is the discount rate which makes NPV equal to 0. Notice that what I wrote here could also be written as follows: minus 100 plus 10 over 1 plus r plus 10 over 1 plus r squared plus 110 over 1 plus r cubed, and all this is equal to 0. What I've done on the right hand side is simply rewritten this expression. The left side of the equation is simply the NPV of the project. So the discount rate, which will make NPV equal to 0, is the IRR rate. Finally, what is the IRR decision rule? If the IRR is greater than the required rate of return, then accept the project. Simplistically, right now, think of the required rate of return as the return that you require, or think of it as the cost of raising money. In other words, if this $100 can be raised at a 8% rate, it costs you 8% to, say, borrow 100. Would you do a project which gives you a return of 10%? The answer is yes. If your IRR is greater than this required return of 8%, then you accept the project. On the other hand, if your required return was 12%, because it costs you 12% to raise your 100, then it does not make sense to do the project. And that's the second sub-bullet over here. If IRR is less than the required rate of return, then you should reject the project. What you are looking at here is the decision rule for independent projects. What about the IRR decision rule for mutually exclusive projects? What you do there is select the project with the higher IRR as long as the IRR is greater than the required rate of return. Let us consider this example. Given what you just learned, how would you come up with the IRR of project A and project B? Here is what you would do. This is the long-winded method. We said that the IRR is that rate which makes the present value of the future cash flows equal to the initial investment. The initial investment is 1000. Present value of future cash flows would be 500 over 1 plus r plus 400 over 1 plus r squared plus 300 over 1 plus r cubed plus 100 over 1 plus r to the power of 4. This is extremely difficult to solve, and you might plug in some numbers for r to figure out which number will give you 1000. But the best way to solve this problem is to use the calculator. For project A, you again enter the cash flow the way we entered cash flows for the NPV example. Here we do not enter any interest rate because the rate is what we are computing. So once you've entered all the cash flow, then hit IRR and compute, and the calculator gives you the IRR. Just once in your life, you can then go plug this rate into the long-winded formula and convince yourself that it works. For practice, I want you to compute the IRR for project B because you need to be very comfortable using the calculator. The answer you should get is 11.79%.